Hello, everyone. Welcome, welcome, welcome. We are so pleased to have you with us today because we have a really special speaker. He's going to talk about things that we don't usually hear about and we need to know a lot about. And we'll tell you what that is soon. Jonna will do a nice introduction. So if you don't know who we are, we match the equity passive investor to the right syndicator sponsor in the commercial real estate asset, which builds and protects your financial freedom choices. So let us know if you are interested in being a passive investor, and we will help you build your portfolio. Angel knows all about that. So today I have a little quote I think that will support Jack because of the industry he's in. And his opportunity is missed by most people because it's dressed in overalls and looks like work. Who said that? Thomas Edison. Like that. So, Jack, thank you for being here. Jonna, please do an introduction of Jack and his amazing self.
Thank you, Peggy. It's my pleasure to introduce Jack Hollander. Mr. Hollander is a seasoned executive with over 30 years experience. He has been involved in the origination, management, fundraising, and financing of $3 billion worth of alternative and tax-advantaged investment programs. He is often tasked to be the manager of new offerings, to work with sponsor counsel on the development of an offering and due diligence materials, followed by organizing a syndicate selling group, and lastly, engage in and support the capital raising by attending and speaking at conferences, investor meetings, as well as to CPAs and financial advisors. Mr. Hollander also seeks out financial institutions for real estate owners and developers seeking capital in the development, acquisition, and value add repositioning across multifamily, office, industrial, and retail asset classes. Mr. Hollander began his career in financial services in 1982. He received his law degree from Brooklyn Law School in 1981 and a master's of law in taxation in 1982 from New York University School of Law. Mr. Hollander is a member of a FINRA test writing committee and was the chairman of the Investment Program Association, now the Institute of Portfolio Alternatives, from March 2005 to November 2011. Mr. Hollander holds a Series 22 and 63 security license. Jack, if you want to go ahead and take it away.
Okay, thank you. Appreciate it, Peggy, and to you, Jonah. So I guess that's probably appropriate now to try to share my screen. Okay, believe we're right here. So can you see the screen?
Yes.
Perfect. Okay, so let me try to minimize this for the moment. Okay, so again, thank you for the opportunity to be on today's show with you, and thank you to everybody that's joining us and listening into this presentation. I know it's going to talk about some tax mitigation strategies, and I know that oil and gas is one that we like to highlight to some extent. And, you know, with a presentation like this, where we talk about different strategies, it's really difficult to get very deep into the weeds. And so this is educational, it's informative, not here to talk about any one specific sponsor or product, but just really to share the ideas, what people are doing, you know, for a financial advisor, just understanding some of these popular strategies that are out there. For those of you that may be a CPA, to know what some of the more sophisticated strategies that are being used. And if you can incorporate some of these strategies into your practice, I think you're doing a really good service for your clients. And then in general, just to know what's out there and what others are doing, because, you know, it's important to know everybody's looking to mitigate their tax liability. And we always say that tax planning should be a year-round conversation. We find, especially in the oil and gas arena, that most people look to make their investment towards the end of the year. And then they first have to learn about the investment. They have to learn how it works. What's the benefit that's associated with it? How much income do I have? So being educated early in the year is really the best thing to do because, again, we want to inspire confidence. We want to be transparent, and we want you to understand how investments work. So being able to have a conversation year round with a financial advisor, a tax professional, is always beneficial to do. Some of the basic tax concepts that when usually I present, I like to really get into, and this is really taxation 101. And, very often people don't apply the correct terminology. An example is in the oil and gas where people say, hey, tell me all about that tax credit. It's not a credit, it's a deduction. So it's really important to just have a basic understanding of how the tax laws work. And so typically from an investment standpoint, are you investing as an individual? Are you investing into a partnership? For those that have their own business, you probably set up a limited liability company or an S corp. Trust can make an investment. Can you have qualified money, an IRA or a Roth or a 401k, make an investment? So the investment vehicle, the wrapper, is very important. But then we get into all these different buckets because I don't think people really recognize the fact that the way the code is set up is really in buckets. Ordinary income offset by ordinary deductions. Capital gains offset by capital losses. Passive income offset by passive losses. Portfolio income, which is different than passive income, that's typically dividends and interest income. Then there are these concepts that you may hear about above the line versus below the line. So when you have income and some deductions, you arrive at what's called adjusted gross income. That's the line, is adjusted gross income. So to get to adjusted gross income, you start with income, and then you have certain deductions. Below the line typically is itemized deductions and the standard deduction. And the itemized deductions, which is really where you have personal deductions that you take, such as real estate taxes, interest on your mortgage, charitable deductions, medical expenses, things of that nature, are itemized deductions. They're individually spelled out versus the standard deduction, which right now for 2024, I believe the number is $14,600 for an individual taxpayer, and you double that for jointly filed returns. So if the itemized deductions, individual deductions when added up, would exceed the amount of the standard deduction, then you're going to take an itemized deduction on your tax return. Otherwise, you're just going to take the standard deduction. Deductions offset income items where tax credits reduce taxes owed. And again, this is an important distinction because a tax credit is more valuable in the sense that it reduces dollar for dollar what might be owed for taxes, but a deduction offsets income to arrive at taxable income, and the tax rates apply against that taxable income amount to determine how much taxes one would owe. Then there's this concept of basis. Basis is what is your cost when you buy an asset. If you buy a stock for $100, your basis, your tax measuring point, your cost is that $100. If you then sell that stock for $110, 110 less the 100 is your gain. When you're in the world of partnership taxation, as an example, here you may invest $100,000, $1 million, whatever it is, that's your original cost, but that basis amount can be adjusted for income received, increases it, cash distributions and losses decrease it. So you have what's called an adjusted basis. And if that asset then gets liquidated, sold, whatever that amount realized is, the amount that you're taking in on the sale versus that adjusted basis will determine the amount of your gain. And remember that not all income is taxed at the same rate. Capital gains are taxed at a lower rate. ordinary income items, the maximum rate right now is 37%, but there are 7 different tax brackets. So not all income is taxed at the same rate. You have to hit different thresholds, if you will, for the rates to go up. And that's why we say we're on a marginal tax rate system. So I'm going to just briefly explain some of these items: 1031s, opportunity zones, bonus depreciation in oil and gas. I don't want to get into solar tax credits, but more people are looking to take advantage of the solar tax credits that are available. A lot of times you hear about it with a home, you want to put solar panels on a roof, and there are credits, there are incentives that the government gives us through the tax code to inspire investment opportunities. Charitable contributions is another arena. However, there have been certain programs, partnerships over the last several years that have somewhat taken advantage, and I'm saying this with a little bit of a smile on my face, but these syndications have somewhat taken advantage of the rules and created these tremendous charitable deduction opportunities that has really caught the attention of the IRS, and they don't like it, and it's very risky, and we've seen some changes in the tax law with respect to that. So very risky. You have to notify the IRS that you're reporting, you've invested in some of these types of transaction. It's called a listed transaction. So something that we don't promote very often right now. So with respect to 1031 exchanges, if you are into real estate, and more people are involved in real estate, and you hear about 1031 exchanges, and this is where you will swap out a piece of real estate. You're selling an asset at a gain, capital gain, it's real estate, and you want to invest in another piece of real estate to defer that capital gain. Remember the concept of deferring and a deduction. Okay, here we're deferring. We have that capital gain, and we're going to push off the obligation to pay the taxes into the future. With respect to 1031 exchanges, they're very technical, so that you have to involve what's called a qualified intermediary, has to hold proceeds of your sale. They're involved in the transactions of selling the property and buying new property. And when I say it's very technical also, you have to identify replacement property within 45 days of the closing of the original property that you're selling. And you have to close on buying new property within 180 days of the sale of the old property. And there are special rules also relating to the mortgage debt that was on the original property, and they may be encumbering the new property. And so in some situations, there can be taxable income associated with the transaction, and that is called boot. But here, the general concept is you're taking a piece of real estate and you're investing in another piece of real estate, a like-kind exchange, to defer capital gains. Then there's the concept of opportunity zones. This is something that was enacted in 2017 as part of the Tax Cuts and Jobs Act. And the governors of the various states were able to identify certain parts of their state that were, let's say, low income, parts of the state that really can use a boost from investment opportunities, be it real estate or businesses investing in that part of the state. So if you take an asset and you sell that asset and you're creating a capital gain, again, this is a deferral mechanism, you're deferring capital gain and you invest in that opportunity zone fund that's going to invest in real estate or a business in that defined opportunity zone, you are able to defer the tax liability on that capital gain until the end of 2026. Now, keep in mind, this started in 2017, and so it was very popular because you had this deferral going out all these years until the end of 2026. Plus, for the first couple of years, you were able to minimize or reduce the amount of that potential capital gain. But because now we're closer to 2026, you don't have that same benefit of reducing that gain. So it's becoming a little bit less popular. But the other significant advantage of an opportunity zone fund is that if that asset that's part of the fund, that real estate that's being developed or bought or whatever, or that business, if after 10 years it is sold at a profit, you don't have to pay tax on that profit. So it's another deferral long-term, but you get to eliminate potentially some substantial capital gain down the road. Then there are these partnerships that now take advantage of what we call bonus depreciation. So starting in 2017, if you had certain assets, it could be equipment or real estate where the useful life is 20 years or less, you can take 100% depreciation on the cost of that asset. Okay, that's pretty big because typically, you may be depreciating an asset over 20 years, 15 years, equipment maybe 7 years or 5 years. And typically residential real estate's 27 and a half years, commercial real estate, 39 years. But if you're 20 years or less and you could write off 100% of that asset in that year, that's a tremendous bonus. And if you have an investment opportunity where you put leverage on it, so you invest $100,000, there's now $300,000 of leverage for a total cost. Remember that basis concept, total cost of $400,000 that you're depreciating. In these types of programs, they are generating with the correct amount of leverage in the area of 65-70%, greater than a one-to-one write-off. So as an example, last year, I'm aware of somebody that did a certain program, did $1 million investment in a program that does sale leasebacks with gas stations. And they had close to 70% of leverage on the investment. And the investor, for the $1 million, got over a $2 million deduction because of the depreciation last year. Now, the bonus depreciation as it's been, so last year you got 80%. This year it's 60%. Next year it'll go down to 40%. But there is some pending legislation in Washington to have the bonus depreciation be for 2023, 2024, and 2025 back to 100%. So we'll see what happens if that legislation can get passed. Now, oil and gas. And I know a lot of you are interested in what's going on with oil and gas investing. And here there are tremendous opportunities. And so I want to start differentiating from what we just talked about. And there are different ways to invest in oil and gas, as I'm sure everybody knows: stocks, mutual funds, ETFs, master limited partnerships, which were much more popular years ago. And a master limited partnership, by definition, is nothing more than a publicly traded partnership. These were very popular about 10, 15. The entity itself, the public partnership, they had to keep doing a lot of acquisitions. They incurred a lot of debt. And by incurring a lot of that debt with depreciation, a lot of the distributions were sheltered. But as we all know, changes in the energy market, these types of programs are not very popular today. There are royalty programs, which are income only, so you don't get any significant tax benefit. And then there are these direct drilling opportunities where a company is going to drill new wells, and that's where you can get tremendous tax savings this year with some further tax benefits going forward that I'm going to mention in a moment. And now we're also starting to hear about companies going and doing what we call recompletions, where they're going to acquire existing wells and going back into that well to capture what might be left behind in terms of the oil or the natural gas. You can get the tax benefit. It's a lot cheaper to be involved with a recompletion than drilling a new well, but there are, programs out there to do this kind of work. You get similar tax benefits from doing these kinds of programs. So the benefit of a direct investment in oil and gas is the fact that even for this year now, you can reduce ordinary income. We're going to call that active income. That's wages, portfolio income. You can offset capital gains. However, the way the tax return works, you're first going to offset ordinary income items before you offset capital gain items. We talk about the bucket of passive income. An investment in an oil and gas program can also offset passive income. If a stock option creates income, can have the benefit of reducing the income from that. Alternative minimum tax. This is where you have an alternative to the regular tax liability. You have income deductions to get to regular taxable income. You have to add back certain deductions to come up with alternative minimum taxable income. And very often with an oil and gas program, we can reduce that alternative minimum taxable income upon which the AMT rates apply. So you're in effect reducing the AMT as well. Self-employment income. For those that are self-employed, this first year deduction can offset self-employment tax. Closely held C Corp business income. Here again, 5 or fewer or more than 50% of the business can invest in an oil and gas program and offset their active business income. I mentioned it a moment ago, 1031 exchanges, you can have boot income. An oil and gas program can actually offset that boot income. And then for those that are doing pension distributions, required minimums, Roth conversions, things like that, again, any source of income, an oil and gas investment can provide a deduction, not a credit. It's a deduction against the income for 2024. So how is that accomplished? Well, the majority of drilling costs are called intangible drilling costs. They may represent 70, 80 or so percent of the actual cost to drill a well. And those get passed through because typically the investment is done through a partnership, a limited partnership. Okay, so you have the pass-through of the intangible drilling costs, and it's going to lower adjusted gross income. So remember what I said earlier, you have income deductions to get to adjusted gross income. The pass-through of intangible drilling costs lowers adjusted gross income, so it's not an itemized deduction, and it's not part of the standard deduction. One of the things that Tax Act took away the deduction for real estate taxes and income taxes in some states. It's limited to $10,000. Those are the SALT deductions. And hopefully through some new tax legislation, we'll see the SALT deductions come back. And maybe when we have the sunsetting of the 2017 provisions, you can go back to the full deductions. But right now, as a way to offset the loss of those SALT deductions, you can invest in oil and gas and create a nice size deduction for oneself. Lowers what we call qualified business income. There's another deduction when the program is generating income. There's a 20% deduction for that. So again, there's a lot of different tax benefits involving oil and gas that you just don't see from other types of investment opportunities. So this deduction typically is about a 75 to 90%. It could be 100% deduction of the investment amount in this year. And this is very much tax code supported. So this concept of having this deduction of 75 to 90% or even higher can offset active income as long as you go into the oil and gas program as a general partner. And here's the code section I'm showing you, 469C3A, that provides in an oil and gas program, if someone is at risk, i.e. they're a general partner to start, then you have an active deduction. If someone doesn't have that, or they have a lot of passive income and they want to create a passive loss, they can do so as well. You can get the same amount of the deduction. You come in as a limited partner, and that pass-through of the intangible drilling costs is now characterized as a passive loss as opposed to ordinary deduction. So how are these oil and gas programs able to do so? And I said earlier that a lot of the investment takes place in the last part of the year. Well, as long as these IDCs, intangible drilling costs, are prepaid by the end of the year, and as long as the company, the sponsor, if you will, starts to drill the well, meaning spud the wells within 90 days after the close of the tax year, that deduction of 75 to 90 for the 2024 tax year. So even if someone comes in early in the year, they come in October, November, December, you can still get this tax benefit. Other benefits, as I mentioned, if somebody is self-employed, then this pass-through of the intangible drilling costs actually carries over to the self-employment tax form to reduce self-employment income. For closely held C Corps, which are not pass-through entities, these are actual tax-paying entities themselves, where 5 or fewer or more than 50%, that entity can invest as a limited partner and offset its active business income. So again, it's an exception to the rule. Here you could be a limited partner and generate an active deduction for a closely held business, even though, again, they're a limited partner, not a general partner. And typically, part of the cost to drill a well, there's equipment subject to 7 or 5 year depreciation. So as the income comes out, it is partially sheltered by the depreciation deduction, and bonus depreciation is available. And there is something called a 15% depletion allowance. So again, against income, 15% is an automatic deduction. So it's not 100% taxable. But with oil and gas, this is something, in order to be compliant, I always like to say, you got to manage your expectations. Like any other investment, you want to know what you're getting into, how it works, what the expectations are. And in oil and gas, because it is an illiquid investment, okay, there's no readily available secondary market. The question is always, how do I get my money back? How long is it going to take to get my money back? Well, you get your money back from the tax savings, first year tax savings. If someone put in $100,000 and you're getting, a 90% write-off, you got a $90,000 tax deduction, and apply the tax rates against that to come up with their actual tax savings are. And let's say it's roughly 40% between federal and state. Okay, now they need $60,000 of cash flow to have $100,000 of benefits, and then they will keep getting distributions from the partnership wells for many, many years to go. But people need to understand that the wells will produce less and less as the years go on. It's a depleting asset. It is not an appreciating asset. So you will get, investors typically get maybe 50%, 55% of lifetime production in the first 3 years or so. It's called flush production. That's where you're going to have the greatest amount of production. You can have cash distributions 15%, 20%, 25%, offset by depreciation, offset by that depletion allowance. But again, commodity pricing is the biggest variable. And I will tell you, where natural gas pricing over the last couple of years was in the $3 to $4 range per 1,000 cubic feet. Right now, natural gas is about $1.60. Oil is about $75 to $80. So that seems to be a threshold that we see right now. But again, there's a lot of factors. The Saudis would like to see oil prices higher. What Russia's doing with commodity pricing, liquefied natural gas, exporting it. But, we've seen a very warm winter here in the Northeast area where I am. And that's played a big part in why you see natural gas pricing being as low as it is, together with the fact that those that drill these wells and find the production do a phenomenal job. They're very cost effective, so you can drill a well these days for less money than years ago and find more production. So there's a lot of production out there, but again, supply and demand, you got a lot more supply than the demand aspect. I always say when it comes to oil and gas investing, to capture the distributions in the brokerage account. If you're going to have double-digit distributions early on, capture them in the brokerage account and make the investment as part of a portfolio strategy to invest in other suitable assets for the portfolio. This is really about time value of money. You're going to get a return of capital very quickly, but use it wisely, because before you're getting a return on the investment, okay, you're getting a return of the investment. And while you're getting that return, it's best to reinvest that dollars, compound those dollars. I have this little chart here that I put together. It may be a little bit difficult to see. Peggy and Jonah, we can distribute this to anybody that might be interested. It's really taking today's discussion, talking about 1031s and opportunity zones and leveraged depreciation in oil and gas, and just breaking out into, as an example, is it a deferral or a deduction? What is the income affected? Capital gains, passive, active or passive? What's the asset class? How does it work? What's the risk profile? So happy to share this with anybody that might be interested. And just last point here, and then we can take any questions or comments. The 2017 Tax Cuts and Jobs Act has what we call sunsetting provisions. So as I talked about, the state and local SALT deduction might be eliminated so we can have full deduction. Income tax rates, right now we see the highest rate at 37%. It's going to go back higher to in the 39%. You've probably heard a lot about estate and gift tax exemption amount. Here's an area, certainly you want to talk to your estate planning attorney to make sure that you're maximizing today, taking advantage of the estate and gift tax exemption amounts, because they're going to be reduced substantially unless the law changes at the end of 2025. And there are other provisions here, as I mentioned, about bonus depreciation, things like that. So just be aware, stay focused. As we said earlier on, it's good to talk about tax planning today and not wait till it's too late to do so. And that's the presentation. Here is my contact information, my cell phone, my email. So if anybody has any questions, I'm happy to answer your questions. Thank you.
Thank you for a great presentation, Jack. That was a lot of information. And if you understand taxes, I'm sure it was fine for all of those, but for those who don't really understand taxes and they actually have a CPA that does everything, you want to make sure that your CPA listens to this. So send them, when you get the recording, send this recording out to them so that they can look at what your tax position is and be able to give you good advice like that. So besides me, does anyone have any questions? So my first question is, I want to know if you and Ted are related. Not related.
And with Ted, no.
Ted says no.
And Jack says no as well.
Yeah, okay. Because Ted is in the Chicago area and Jack is in the New York area. But I have a question.
I actually may have met Ted. I may have met Ted.
You broke up.
If he attended. We may have made sure to say hello to each other.
Okay. What conference was that?
Family office.
You keep breaking up, so.
One of the conferences Family Office Club, one of the conferences last year.
Maybe not. Ted doesn't go to those really. Okay. Well, I have a quick question, and that's about 60 years of depreciation. So you get to write off 60 years of depreciation, but don't wells pump longer than 60 years?
Yeah, no, so like anything else, depreciation would be, let's say, 5 or 7 years. And
Mm,
that's the timeline in which you write it off. And then, yes, the wells can last anywhere from 15, 20, 50 years. That's not unusual. While
okay.
depreciation may be exhausted, that 15% depletion allowance continues as long as wells produce. That does not go away.
Okay. Thank you very much. You're breaking up, Jack, so just wanted to let you know about that if somebody asks you to repeat. Jonna,
Okay.
Thank you.
Okay.
Of course, I have questions. So I have a question on behalf of one of our investors who couldn't be here. Jack, I think you know what that question is where to, you mentioned that you like to put this in a brokerage account so that you can reinvest the distributions. But can you give your thoughts on whether to put this in, for example, self-direct out of qualified funds or not?
I am not a fan of having qualified money invest directly into these programs. One, you lose the benefit of this 75 to 90% write-off against active income. So why give up such a, people are tax planning, they want to reduce their active income, they want to reduce their current tax liability. So why put it into a qualified plan or IRA or anything like that? The other thing is it could generate UBTI, unrelated business income. So you certainly want to avoid that. And a couple of years ago, in talking to an advisor, he was telling me that there was some program that was allowing someone to invest, through their IRA. And then what they found out, because it generated UBTI, you needed to have an administrator handle that investment for purposes of the tax return for UBTI. And the administration cost was greater than the actual tax liability. Okay. Not a happy camper. So you don't want to run into a situation like that. The other thing people were thinking about doing, you invest through the IRA, then you put in, let's say, $100,000, excuse me, into a partnership. You then take that partnership interest and convert it to a Roth IRA, thinking that you would have discounts. You have a discount for lack of marketability. You have a discount for having a minority interest, lack of management. So that $100,000 investment, you discount it to maybe 40,000, 35,000, something along those lines. You don't want the IRS to come and challenge what that discount was. So to me, you're creating more risk by putting it through that vehicle, that wrapper of doing it through the IRA or otherwise, where we all know exactly what the rules are when you invest individually to offset your regular taxable income.
Okay, thank you. And then can you clarify, so you say you enter to get the active deduction, you enter as a GP. Do you stay a GP for the whole life of the investment?
That's a great question. And first, let me just say, typically the way somebody comes in as a GP versus an LP is you just check the appropriate box on a subscription document. Okay, just make sure the right box is checked. And then after the wells are drilled, next year as an example, because they're drilled, you got the benefit of the write-off in 2024. Usually the sponsor will convert everybody to a limited partner status, to non-taxable event to do so. So it doesn't, no harm, no foul to do so. Interestingly enough, when somebody is converted from a GP to an LP, even though now they're a limited partner and the K1 will indicate that they are a limited partner, that income is still considered active income, not passive income.
Oh,
But you are
okay.
correct in your question that people do not stay a GP very long. usually the year following the year of investment, they automatically get converted.
Okay, good. And then I want to make sure that I understand. So the standard deduction and then the deduction for this. So if I invested $100,000 and the deduction was $75,000, do I get to take the standard deduction as well as the $75,000 deduction?
You absolutely do. Correct. So that's why you're distinguishing an above the line deduction versus below the line. And so that, and again, that's a great question that, yeah, you get that full benefit of the oil and gas deduction, and you would still get a full benefit if it's itemized deductions or standard deduction.
All right, thank you. That's all for me.
Thank you. Paul.
Thanks for your presentation, Jack. Question for you regarding solar tax credits. I was wondering if solar tax credits can be used in investment properties. Can we take a deduction there?
My understanding with respect to solar, if the investment property is considered passive income, you're generating passive income, the credit can be used only against the tax liability associated with passive income. So the credit could not be used to offset tax liability from portfolio income, W-2 wages, or anything like that. It can only be used to offset tax liability associated with passive income.
Wow,
Thank you.
that's great.
That's what makes it complicated.
Wow, that's why you need a good CPA, right? Is that it, Paul?
Yes, that was it. Thanks so much.
Okay, Angel. Thanks for
Hey,
being
so I
here.
have two questions, I guess. The first one, we JV'd into 2 oil wells. And so we got the 80% deduction in the first year, and this was a few years ago. Would they change us from JVs to something else after a year?
Probably not,
Okay.
because you didn't do it through a partnership, right? You came in just individual, whatever entity you might have used. But for the JV partner, they're not looking at it GP LP scenario. You just have a piece of the working interest, meaning you're an investor owner of whatever portion of the well. So you get the income and you're responsible for the expenses.
Right. And then I guess my second question is my husband's family, they have a family limited partnership that's been there for generations. I think Jason is 4th generation, but they've got oil on their land on the Permian Basin, so West Texas. Now, the oil company that's been going out there updated all their equipment, and his aunt negotiated some like multiple 7 figures deal for them to be able to do all this stuff. But if that was an equipment change, so she distributed money on it so that we could pay the taxes. But if it was equipment change, shouldn't that have been deductible?
It sounds like if they bought the equipment, it's a new expense, then yeah, it sounds like it's something that could have or should have been deductible.
Okay. Because we wound up having to buy a property because all of a sudden we had a 6-figure tax problem.
Yeah, but it could have been lumped into the ordinary income, the line item for that. So, without recognizing that it was actually depreciated.
Okay.
And who does that depreciation schedule, Jack?
The accountant for who's ever handling the partnership or the joint venture accounting.
Okay, thank you. Do you have that, Angel? Okay.
Yeah, I'll just have my husband, it's this guy Vernon. I'll just have Jason email him. Because I felt like we shouldn't have been forced to have to buy a property to mitigate taxation based on something that was depreciable, in my mind.
Okay. Yeah, well, you have to watch your depreciation. when you know you've got it. And that's the only part, my understanding is depreciable on gas and oil is the drilling, all the equipment. I mean, what else is there besides equipment and the barrels that it gets stored in?
Well, yeah, but and then the intangible costs are not subject to depreciation. So that's why you can deduct them all in the first year, or actually the way the law reads, you can amortize them over a 5-year period of time. But it has to be amortized equally. So unlike a passive loss, which if you can't use it this year, you can use all or any part of it next year and keep carrying it forward. With the IDC deduction, if you want to, you can spread out that deduction evenly over 5 years. Or you can use it all the current year. It's at the option of the taxpayer.
So would you think that it's best if people start a partnership to invest and go in as part of the GP? Is that the best way to get set up for good tax deductions and for you become a passive, do you still get, could you say that one more time? I'm sorry.
No, you're correct. That, if you're looking for tax mitigation, you have a lot of income, then you want to, if you don't have passive income, and you're looking for tax mitigation with oil and gas, you have to start as a GP, general partner.
Okay.
I mean, you can start, as I said, you can start as a limited partner, but you have a passive loss. And then as the income comes out, that would be passive income.
Right.
And you're carrying forward the passive loss just to offset that income.
But if you come
So
in,
from a, right.
if you come in as
So
a
it's
general
what,
partner,
yeah. Right. So it's what income are you looking to shelter? Current income or, income coming out over time?
thank you.
And I would say, because, the question about being a general partner, my experience, I've done this a long, long time. I've seen a lot of companies. I've never, ever, and I say this sincerely, I've never, ever heard of or seen any investor general partner have a liability issue because they were a general partner. And so, you're dealing with a high net worth individual. They got a lot of money. They're like, oh, my whole net worth is at risk because I'm a GP. Well, sort of. I say sort of. But at the end of the day, I've never seen anybody ever have a situation because they were a general partner. And as Joan asked the question, everybody would be converted to a limited partner status next year. But you have to keep in mind, if I have a car accident today, okay, and I get sued 3 years from now, okay, even though I got converted between now and 3 years to a limited partner, I'm liable for what happened today, not because I'm a limited partner 3 years from now.
Understood. Does anyone else have any questions? No, this is kind of a complicated subject for a lot of people. Eugene, do you have a question?
No, I don't have a question. Just a couple of comments. One, my dad always told me have a good accountant and have a good lawyer because you just become an expert on what you become an expert on and let somebody else handle it. And after listening to this presentation, that's why I let somebody else handle it because it's a lot of stuff that's in here. And I thank you for the presentation. Two, I want to say thank you, John, fellow Long Islander.
Yeah.
Andy Rooney fact, and if Andy Rooney says it, it has to be true. 1 out of every 7 Americans was born in Brooklyn. He said that on 60 Minutes one night. And if you get into the right crowd, his statistics usually bear out. So that's all I wanted to say.
And Gene, thank you for the comment about working with a professional because we work very closely with the CPA community. Can anybody invest in these things? We want to be transparent. We want people to understand the investment, how it works, things of that nature. And we find also a lot of CPAs do need to be educated on this. Not everybody sees this all the time. This is, it's a specialty type of investment. Even when I've invested in oil and gas deals, I have to tell my own accountant how the IDC deductions should be working. So I do have, if anybody's interested, that I'll give to Peggy and Jonah what I call key tax points that lays out all the various code sections related to oil and gas. Happy to share that with everybody. Same thing with having that chart that has some differentiation between these different types of investments, just to have a basic understanding what somebody's looking at. But again, we do believe it's really important to have a team, like you said, whether it's lawyers or accountants, tax professionals that can help evaluate and understand something. But the other thing I wanted to also mention, and Peggy and John are familiar with this, a lot of the oil and gas sponsors out there, one of the benefits of working with a sponsor that's in the so-called community is that they have to go through due diligence, third-party due diligence. Okay, so I can't show you something potentially that has not gone through any sort of substantial due diligence. Okay, third parties have to look at it. They got to evaluate it. They got to stress test it. They got to look at the company, all that kind of stuff. It's just about the transparency. It's to inspire confidence. And so, this is a tricky market, just like solar, all these other things. Who's doing what? Who are you investing with? And the more eyes that look at the opportunity and the company, it's for everybody's benefit.
Yes, Angel.
I just thought of something. So when you invest in oil and gas and it dry holes, do you get to deduct the full amount that you invested in that year?
Yeah, you still can get the benefit of the intangible drilling cost deduction because you drilled the well.
Mhm.
You drill the well, so you're entitled to that deduction. The good news is, in today's world, you want to invest in a program that is called developmental, not exploratory. You don't want to be a wildcatter. You don't want to be the first one drilling in an area where nobody's drilled before, right? Because you just don't know exactly what you're going to get. If you're drilling in an area that's been pretty much developed and all
Mhm.
around wells have been drilled and production has been found, the likelihood of having a dry hole is going to be pretty small. It's
Yeah.
pretty
Now,
much
my friends were on a proven field, but the drill migrated, and so they still dry holed. It
well,
sucked
it
really
does
bad.
migrate. It does migrate. I'm not saying it doesn't, but that's what people, or they try to have infill, so you're surrounding it and going in the middle there, where it hasn't been drilled yet, because to your point, Angel, no two wells are going to be exactly alike. Even though the data says here's an average, here's what it should cost, but you're right, trends move. Trends do move. And so that's why, on some level, everything is new and it's somewhat exploratory, but because you're in a field that has been substantially developed and the technology is such today with seismic readings and all that, and the operators know how to evaluate what should be there. You're going to find something. You should not have a program where you're having a lot of dry holes, if any.
Yeah. Well, it was the first one they'd had in a really long time. It's a family office that I'm friends with here, and they have a whole bunch of stuff in Permian Basin again. But they had decided, I want to say that they were drilling in Louisiana, and it was proven around them, but they hadn't drilled there before. And that all the geographic reports, everything said there's oil here, and they migrated. They hired a company to pull them back in, and even though it pulled them back on course, it didn't quite get close enough. And
Yep.
it
Well,
was a sad moment.
my colleague Art is on the call here, and he's an expert in Louisiana, shallow water, Louisiana drilling.
Oh, shallow water. Yeah, we know about that.
My Papa Jack was with Shell, and my dad was doing offshore oil well drilling like in the late his mid-70s. So they lived in Plaquemine.
So
So my
I
grandkid, that's what my grandkids call me, Papa Jack.
have another question that like Angel's brought up, because we get calls where oil drillers or oil, whatever they are, call us and say, we've got two wells, where others say we have a company and we're located in several areas like Louisiana, North Dakota, and Texas, for instance. So I see investors protected when they're going into a company that's not putting you into one well, but you're in all of it. Aren't you better protected? Because otherwise you could be in something that just happened like what happened to Angel.
No, absolutely. It's about diversification. Like I said, the wells will perform on average, right? Some will be a little bit better than others. Some might have a little bit less production. So, and typically in these kind of partnerships that we can provide exposure to, no one's investing in one well. You have an interest in every well that's part of the partnership.
Right.
Correct.
Okay. Thank you. Any other questions? Because we are at the top of the hour. We've had an amazing presentation.
Uh,
And I thank you very much, Jack, for that. It's just been really, really great. We hope that you will consider coming back again because, oh my God, the knowledge you have in your head is just blows me away.
it's scary, I know. But seriously, if anybody needs, anything from us, like I said, key tax points, oil and gas code sections, that chart in the presentation, happy to share that information.
I would like you to send that to me because we send out this YouTube to everybody, even though they're not on the show. We also send them to everybody that we know so that they could have that chart also, if that would be okay. If you could
Sure.
just email that to me, I would appreciate it.
Absolutely. Thank you.
All right. Thank you.